How will the housing market affect multifamily investors, ladies and gentlemen? That's the question, is how will you be affected? How will you be affected by, if you're a multifamily investor, and should you be investing in multifamily right now in lieu of what's happening with the housing market? Well, let me go over some details and some facts with you guys that are going to affect the housing market and the relation to the housing market and multifamily, okay? One of the big things that you guys got to pay attention to is, okay, there's obviously an inventory issue that we've been talking about for God knows how long, right? We've been talking about this housing issue and the shortage of housing, and that's why inflation went up so much, house prices went up so much, was because of what's happened over the course of the last 15 years. Since 2008, the builders retracted. And so what's happening right now with the housing market is what? Builders are retracting. And so if you guys watch my YouTube video that, actually, I don't even know if it's published yet. It might have been out yesterday, or might be getting published here tomorrow. One of the things I talked about is how there's going to be an 18% retraction in the market from tract builders, from big builders like D.R. Horton, Pulte, LGI, Toll Brothers, because these guys are doing median homes, you know, and the average median home is at that $355,000 to $380,000 mark. And so that's where the masses of people, 74% of our population lives paycheck to paycheck, 74%. And so the people that are buying the median homes is at 74%. And so when the housing market contracts, and when the buyers in that median market specifically, when that median market gets affected, one of the big things that happens is that they can't afford to buy homes. And so what happens is these people start migrating to other places because they still need a rooftop over their head. They still need a place to live. They still need to, they still need a rooftop, you know, to call home. And so one of the big things that's happening with the housing market right now is that builders are contracting because of what happened back in 2008. Now, on average, we as Americans, every decade in America, we build approximately 11 million homes every 10 years. If you go back historically and you Google how many homes were built in America every 10 years, you'll see that there's between 9,000 and 12,000 homes built every single year. And so one of the big things is what happened in 2008 is that from 2008 to 2020, there was only 6 million homes that were built. So we underbuilt by 5 million homes, And so now that's almost equivalent to the exact number that is currently in need of here in America. It's about 5 million homes that were short. And it happened between the 2008 and 2020 timestamp, boom. And so what's happened, guys, is that now we're sitting at a place where there's a shortage of homes, and we still haven't met and fulfilled that need of homes. So yes, we went a little gangbusters over the last 2 years, but it's not even feasible. It's not even feasible for us to come in and build the 5 million homes in 2 years. It's going to take at least half a decade. So we need to keep up with the current demand. Plus, we need to build another 5 million homes. And so how does this affect multifamily? How does it affect assets just like this? Well, I'll tell you, assets like this get stronger when the housing market is compressed, okay? So when the housing market compresses, multifamily goes up in desire, right? Because people can't afford the mortgages. Interest rates are high, real estate is high, wages go up a little bit, but when the market contracts and people can't buy, they're forced to rent, and that's what forces rents up. Now, rents have plateaued, and I think rents are gonna compress a little bit over the course of the next couple years. But we're up so high on rent rates right now that even if they compress, multifamily, the affordable housing aspect of multifamily is going to continue to get better. So we end up getting rid of amenities like this one right here, where you put out the outdoor barbecue grills. You have dual grills right there. You do a pergola, you know, a patio cover like this, you know. And if you do maybe something like this, but you get rid of the swimming pools, you get rid of some of the amenities like the big gyms, and you come in and you build simple, and you build really simple, hence being able to give people a lot more for their money in regards to housing and rooftops. So where maybe one of these 2-bedroom apartments would normally rent in a Class A apartment complex at $2,000 a month, we can come in and give that to them for $1,300 to $1,600 a month, save them $400 to $600 a month in rent. And that's where the real need is right now, is affordable housing, because there's just not enough affordable housing out there. And so as the residential housing market compresses, these assets will become more desirable. And so these are the rooftops that are gonna fill that 5 million rooftop shortage that we're still short of. In fact, we're not only still short of it, but if we're gonna experience an 18% compression in housing, where there's gonna be 18% less homes built next year just because builders get scared, then what's gonna happen is there's gonna be a larger need for housing, extending the amount of time that it's gonna take us just to fulfill our current needs for housing right now. So if we were 5 million short, and let's say it takes 2 years for builders to say, okay, let's vamp back up. We're a publicly traded company. We need to keep our stocks right. People are pulling their stocks. We're scared. And so it's gonna take us 2 years, a year that they contract, and another year just to catch back up. And so one of the things you have to remember is that if it takes 2 years and they contract by 18% this year and they try to vamp that back up, it's gonna take them 2 years. So that's 2 years of 18% compression. So at that rate, now they just extended how long it's gonna take to be able to fulfill the need for those rooftops. So multifamily actually lands up doing extremely, extremely well. Build to rent communities are gonna do extremely, extremely well as well. So if you guys had not seen the live video that I did last week where I talked about, affordable housing, and I also talked about built-to-rent communities. This is what I was talking about, was assets that are going to be most desirable, especially over the course of time. You know, it's the assets over the course of time that actually are lower in cost. I got this guy following me around. He was the guy on the motorcycle. Now he's like following me around. He's like, this guy's doing a live video. I'm gonna interrupt his live video with my truck and my little motorcycle. So, and this is funny, is like they have these garages over here in these places, and people can work on their equipment, and they can work in store even dirt bikes and all kinds of stuff. And so we do a lot of storage stuff like that, but we take a lot of this type of stuff out of it, like these type of fire pits and stuff. They're kind of cool. These don't really cost that much to put in, so sometimes we'll throw stuff like this in there, making it feel like it has a ton of amenities, but they're really inexpensive, you know, stuff like this. You know, got the barbecue grills, and just a simple build, real simple build. So anyways, affordable housing, guys, I'm telling you guys that affordable multifamily is where it's at right now. And then for those of you guys who are following my buy land build house model, we actually just extend outside of that. So remember I said that 74% of the market is affected by what happens because they live month to month, paycheck to paycheck. So in the housing market, listen to this, because multifamily is going to thrive for a while. We're not going to have any shortage of multifamily needs here for at least another decade. We may see interest because of interest rates, cap rates kind of because they're so compressed, they're going to extend themselves a little bit. So the multifamily market will need to compress a little bit as far as rents and cap rates, because if it doesn't, the affordability factor kind of goes out the window, right? And so the affordability for multifamily is going to need to stay someplace where people can afford, otherwise both will get affected. And so smart investors understand that keeping affordable housing where it needs to be is important. I understand that. So we're not trying to go out and nosebleed people, although we want our properties to appraise for more money, but we also want them full. So is it the difference between your property being 80% full with 20% vacancies, or 95% full with 5% vacancies? Because every apartment complex has a 5% revolution every single month. So if you have 100 doors, you're gonna have 5 doors every month that revolve tenants, okay? So that's just the national average, is 5%. And so understand that no matter what, if someone says they're 100% leased up, they might be 100%, but there's usually about a 95% full leasing because of the 5% revolution that happens in every asset class. But ultimately it could be 98, 99, 100% leased up theoretically on paper, but it's 95% is usually where it's at because of the 5% revolution. Now, I talk about the housing model. What we talk about as far as housing, we tell you guys, don't go in and invest in affordable housing unless you're doing build to rent or you're doing multifamily and you're doing You're doing a long-term holds where you're doing buy, build, and hold, where you actually hold the asset, and you do short-term rentals or long-term rentals. Then you can do more cost-effective building models where that's the model that you would seek after, is more inexpensive real estate, so you could do more volume, and then you could do higher rents, and you need simpler builds. But if you're going to build to sell, like if you're going to buy, build, and flip, like you're going to buy a piece of land, you're going to build it, and you're going to flip it for a profit, then you need to be marketing to the other 24% of the population that is just over the mean. Okay, so I always tell people, start building it right now because of where the market is. I used to tell them about 400 grand. Now I'm telling you guys, $500,000. Hit the $500,000 benchmark. And then after you hit that $500,000 benchmark, don't go over $1 million. In fact, if you can stay under $800,000 on your builds, that's a sweet spot. Between $500,000 and $800,000 right now is the sweet spot, because these people in this compressed market, the people that can afford a $500,000 to $800,000 house, those houses aren't being affected financially, and they're not dropping in price like the entry-level homes that are 350, 380 and below. And so if you want larger profitability, hence, if you land up buying, building a house that's like $350,000, your profitability is probably like 50 grand. And so if the price compresses, guess who eats that profitability? You do. And so if it goes down $30,000, I'm not willing to build a house for a $20,000 profit. But if I build a $650,000 house, $700,000 house, and I may have $130,000 in profitability, and it goes down $30,000, I still make 100 grand. So I love that. I love that. That's why that model works so well. And you're marketing to 24% of our population of home buyers as opposed to 74%. And 24% is still millions upon millions upon millions of people. So 24% is over 100 million people that you're still marketing to. These are our parents, our grandparents, people that are making over $200,000 a year. They can afford the payments, and even if they can't afford the payments, most of them buy cash. We get a lot of people, when we focus on the empty nesters and retirees, we get a lot of people that come in from like places like California, New York, Pennsylvania, places where real estate sells for a lot more money, and then they come out here, they retire, and they sell off their real estate wherever it's more expensive, and they come out, they retire, and they build a beautiful home cash because of the equity they have, and because of the capital gains rules, where if you're married, you can make up to $500,000, $250,000 per spouse, $500,000 with zero capital gains. They can come in and buy a $600,000 home, $700,000 home, make $500,000 on their home, pay zero taxes on it, and then they come in with another $100,000. They buy the house cash. We get a lot of that. And so just FYI, that's an incredible asset class. Look, guys, if you guys like the content, smash that thumbs up button, pound and subscribe to our YouTube channel for more content just like this. That way you guys are notified anytime I give you guys a housing market update or I talk about relevant information that you guys as investors, because if you're following this channel, one thing I already know about you guys is you guys are either aspiring to invest or you're already investing. You're already sophisticated and know where the direction that you guys are looking at moving towards. Now, if you guys want to find out a little bit more about how to build affordable multifamily housing, at the end of this video, I'm going to have my team put in a video that I did with Cody Sperber, the Clever Investor, and we put this originally up on his YouTube channel, but we also just migrated over to our YouTube channel as well. We're going to put that video to recommend it to you guys, and you guys can see it's a three-phase video, and it's probably about 3 hours worth of content that you guys can go to and understand how to underwrite and how we build affordable multifamily housing. Okay, so I'll drop that link at the end of this video. Give us a couple hours to drop that link in here. Sometimes we'll get DMs and messages going, hey, where's that link? Give us a couple hours, give us 2-3 hours. I'll have my team drop that link in there. They'll put a nice, pretty thumbnail in here, and we'll recommend that video to you guys. But it's pretty cool. That's a sweet video that you guys are gonna wanna watch, especially if you're interested in investing in multifamily. Even if you're not interested in investing in new builds, just investing in general, it's an incredible video for you guys to watch. So nonetheless, multifamily is going to continue to thrive. Affordable multifamily is going to be the best asset class to invest in and build to rent communities, which are communities that you build houses. They have a yard. They're individually stacked. They don't have the 4-story look like this does. They're individual houses, and they have a yard, and people love it because it offers them the feeling of home ownership while they still rent. And so built-to-rent communities are big. That's what BlackRock and all the big institutions are investing in right now, ladies and gentlemen, which hence means that
you should be investing in it too, because if the banks are lending money on it, they love that asset class, they will lend for you to go out and build that asset class as well. So anyways, you guys go out and make it a great day, and don't forget, pound that thumbs up button, click and subscribe, and always go out and compound your success.